Good morning. Happy Friday, Financially Fluent Fridays. I got Sarah here with me, Beer Home Team EXP. How you doing, Sarah?
Good. How are you, Zach?
I'm doing real well. Let me do the tag you in here real quick. Whatever. I got to figure this. This is the next step of me figuring it out here. So hold on one second. Let me edit this post and tag you, and then we will get rocking. Oh, you're there. There's your tag. Cool. Perfect. Well, all right. Hey, good morning. Happy Friday, everybody. Hope you're doing great. Just wanted to, we're excited to get going here with you. Sarah and I had a couple conversations that are really important. I know, Sarah, we were talking about a couple things last week that kind of tied into this week. And then I know you've had some experiences going this week that have really kind of brought up some important conversations. And then I've had a few as well. So I really just wanted to jump right in and talk about some options. I think we'll start off with something that jumped in last week that we were thinking about. And we want to talk a little bit about the non-QM options. And so there's, everybody hears about Fannie Mae, Freddie Mac. They hear about FHA, VA. They know about those loans. Those are pretty standard. But those are kind of what we call your cookie cutters. Those are the loans that will fit for the average Joe. But there's a lot of people out there, whether you're a business owner, you're an investor, those sort of things that it might not make sense for. So we wanted to talk about that a little bit. Now, from the realtor perspective, Sarah, I wanted you to chime in. I can talk about the program in a second, but who's the client that you think is going to qualify best or that you think would be a good fit for a non-QM type of loan?
So the clients that I see the most that are seeking these types of products are people that own restaurants, own businesses that are like myself. I would be a great candidate for a non-QM product. Just people that don't get your standard W-2. They've got a lot of reported income. I've heard rumors, Zach, and correct me if I'm wrong, but are bank statement loans coming back?
Oh, yeah, big time. Actually, I worked on a couple of them this week. So good example. Let's start with bank statement loans because that's for a person who, for example, they have a great tax accountant and you look at their 1040 and they show zero on the bottom line or very, very low. They minimize their taxable exposure. A bank statement will show the cash flow. And we can look at 3 months bank statements now. We can look at 12 months bank statements or 24 months, and we can look at business or personal. So it really just depends on how that person has the business set up. So for people like us who a lot of cash flow goes through the bank account, but then obviously we're going to write off as much as possible. Yeah, definitely that's an option. There's another thing also, if you're a 1099 employee, we can even just look directly at your 1099s and they can use that cash flow. They hit you with what's called an expense factor, and it depends on the bank you work with. But they'll basically say, okay, well, you have this much reported income in, and what we'll do is we're going to hit 20% or so for the expenses, and then after that, that's your bottom line. So it saves you, and they don't have to even look at the tax returns. Because one thing I've seen as a lender is that when you get into tax returns, sometimes it can get ugly, and it doesn't really help that person. And they can make a ton of money, but realistically, it doesn't report. So.
Zach, how are the rates on those products? Because obviously I would assume that the bank looks at it as more of a risk because it's not such a cookie cutter loan. So my assumption would be that rates are higher, but like what does that product kind of look like? Like how much do I need to put down and what are the rates looking like in order for me to qualify for something that's not standard?
That's a really good question. And what you'll look at, typically the rates are going to be higher. Right now they're in the sixes for what I've priced out for most people. And that's just a kind of a standard. I've looked at a lot of those programs this week because I have a couple buyers that are candidates, doctor for one, and then a business consultant's another one. And they're in the sixes, just bottom line. But for them, it's a matter of getting in, getting the property, gaining the equity. Now, you're going to see a couple of different variations. Minimum typically is going to be 20% down. There are a couple of programs that can do lower down payments, but I've seen those are just not really competitive. And most people who are investors or people that have the assets put aside are going to want to actually instead go with the 20% down program minimum. And then it just varies from there depending on the type of property that you're looking at. And I've even seen for investors, for people who are looking at investment properties, which I know you do a lot of, they can actually do what's called the debt service coverage, where they don't even look at the assets or income at all for that client. They look at the property, and is the property going to pay the rent, basically, pay the mortgage, or the rent going to pay the mortgage, if you will. So, yeah.
What are some of the qualifications? Like if I'm staying at home, Zach, and I'm thinking, well, I don't get a W-2, I'm 1099, but I didn't file my taxes yet, or I haven't filed yet, or I did file, but what do I need to think about and kind of bring to you in order to know which program best suits me?
Yeah, so assets for one, we need to know where the assets are. And I would tell people, this is the thing, one of the things I've been fighting with a little bit this week is try not to move money around to a bunch of multiple accounts. Try to keep your assets consolidated at least for 3 months if we're going to use that 3-month program, because that way at least we can track it. So assets, Credit score, they do look at credit for most of these programs. And so, you do want to have the better the score, the better the rate. Now, I have them where they'll qualify as low as 580. So realistically, you can get in, but you're going to pay that premium. Credit's one of the biggest pieces of the puzzle. And those are the two main pieces. That is where's the money and where's your credit score. And then after that, honestly, because there's so many different versions, I mean, we could find a home for anything. But it's when you have money. So a good example, I have a client right now that's a consultant, and the problem I've had with them, and where we're changing gears with them, is that they move money around between 6 different bank accounts. Well, that's one limiting factor, is that you're going to use one bank statement typically for these programs. So you're not going to use 5 or 6 different accounts. And so for them, what we're going to do is we're shifting gears, having all the money going to one account for 3 months, and then we're going to attack that from that perspective. They're buying a primary home. But they also are going to turn one property into an investment property, so on and so forth. But that's kind of what we had to shift gears with them. Is like, okay, stop moving money. First off, I got 6 accounts with 12 months of bank statements. I'm going. So keep your money, keep your assets in one account, and then from there, make sure you maximize your credit. And that's really the main pieces of the puzzle.
Zach, I know that you and I didn't talk about this and what we were going to talk about, but now that you're talking about it, I think it's really important for you as a lender to cover this. As people are looking at homes, what what should they do, and how long does money have to be seasoned in an account while they're in the escrow process? Because I have seen this before where, people move money and then all of a sudden it could no longer be counted as money that they needed. So they had to get like a different sort of gift fund. So is there a general rule of thumb for that when you're purchasing a property?
General rule for like a standard loan is 2 months. So for a basic Fannie Mae conventional loan, VA, FHA, we want the money there for 2 months. For these types of programs, for the non-QM, they're a little more loose on that, but they are going to want to track funds. So if there's a major $200,000 deposit, they're going to want to know where that money came from, just bottom line. But now, generally speaking, you want to have your money there for at least 2 months. That's really important.
Okay.
All right. Well, let's shift gears a little bit now. This is something I think that we're seeing a lot of right now. And this is something, Sarah, you brought up today when we were talking this morning, and it's really important. It's list price versus the sale price. And I want you to kind of jump on there right now and kind of lead us into this, because you see the experience on this firsthand. And I can talk a little bit about how we deal with it on the other side too.
I think the concept that we really need to wrap our head around in this particular market. Now, market shifts and change, right? So this will not be the case forever. This is the case today. And what we need to kind of compare it to is, think about eBay, right? Someone's got something very unique. Like, let's say that this was the only coaster that came like this, and I listed at a price of $10 because it's the only one. Well, that seems a bit overpriced for a coaster. Well, it's the only one like it. This is now the starting bid on eBay. So anyone that wants to buy it comes in above. That's how we're seeing housing go now. So that list price of $499 that looks so attractive, and you're like, wow, my budget's $550 or $525, but this house is listed at $499. I think I've got a really good shot. That's the opening bid. We are not writing offers at $499 because there's no way that house is going to sell at $499. So, and that kind of goes back into, Zach, what can we do about once we start getting into those bidding wars where it starts at $499 but it ends up going for $625, and now the seller only wants an offer that can cover $50,000 in appraisal gap. What do we do if we don't have the cash? Where can we go? We're VA, we've got no money, like no liquid cash. We can qualify for the loan all day, but we don't have the liquid. So this comes back to kind of what we were talking about last week with appraisal gaps, appraisal issues, and kind of how the market is moving in that bidding war sense.
Yeah. And then, so I think that has to be part of the strategy from the outset, right? You have to know and have that conversation up front and say, hey, listen, we know for a fact this property is listed at $615. It's not going for $615. That's the strategy right now that we're seeing across the board. It's because they're so competitive. We're going in, we're listing, I'm seeing them listed low. And the whole idea is getting foot traffic. They want to get as many people in there and get as many interested buyers in that home as possible. And then that bidding war, like you said, starts. And so a couple options when you look at assets, do you have retirement plans where you can pull money out of, which is something that actually I think is not a bad idea. And you can usually do a loan. There's always, first off, talk to your tax person as far as the implications there. But if you liquidate accounts, you're going to for retirement accounts, you're going to end up paying penalty. Bottom line, some people prefer to do that versus paying themselves back. The other option is you get a loan, you pay yourself back the interest. That again, I'd say talk to your tax person. But my experience is that those loans are usually pretty low payment back. It doesn't impact your loan, so it doesn't hurt your ability to qualify. But that's an option. You can have gifts is another option. So those are two things that I think are probably the biggest pieces to look at. And surprisingly, I found this is something that happens more than people would even really think about. Is that gifts are realistic. Gifts happen. Especially family, parents want to help out. And if they're in the position to do it, I found so many parents that have come through, all of a sudden they've got 10,000 they want to help out with, or 20,000. And it's surprising. And most people get uncomfortable asking for that and having that conversation, but you need to prepare for it. So those are the two things I would say, because obviously if you have just enough money for the 3 or 5% down payment and the closing costs, chances are, and you're trying to shop on your top end, chances are you're going to end up having a problem.
Well, I'm glad that you said that about the top end, because I do think that there are options. If I know that I'm maxed out at 600, I may start my search in the low fives. Now, there might not be anything that matches exactly what I want today. I want this nice house. I want it fully renovated. I want 3 bedrooms, 2.5 bath. It might not be the reality for me today. I may have to do what we spoke about last week. I might have to get a starter home. It might have to be in a different neighborhood than I ideally want. But what I'm going to do is I'm going to start leveraging other people's money to get me to where I want to go. And so I think that is really important. The other thing, Zach, that I know we've talked about, and I want to stress it again, is off-market deals happen. They are here. I think every agent has something in their mind that they know of, a neighbor, a seller, somebody that is going to sell soon but has not listed. There are opportunities. I know of one in El Cajon right now. It's a 3-bedroom, 1 bath, twin home, ready to go. I know exactly what price would take it off the market, and it's not listed. There are deals. Find yourself aligning with people that can find the deals, right?
This tags into, I made a post yesterday talking about, agent realtors and what y'all do and how much goes into what you do. And that tags directly into what I said yesterday. Because, there was a post about, people asking to cut commissions, all that. But the big thing is that having the right realtor, having somebody who knows how to find those off-market deals, having somebody who knows how to negotiate those and get those accepted, having somebody who has the connections that can really get those triggers pulled, it's invaluable. And so that really ties into what it is that having the right partner brings to the table. It's hugely important. Massive. I 100% agree with you on that, because just the fact that you have that property, I mean, how many people would be looking for that? That a twin home with 3, 2, bottom line.
But and I didn't mean that to be like a plug, but I'm just sitting here thinking, and I know from the buy side, I've been a buyer. I know how frustrating it was to find a home in my price range that met my criteria. And I ended up buying off market. That was the only way I found something that made sense for my family. And so I know how it's done, and I know that it can be discouraging in this market. But if you're qualified for a loan, you gotta find a way. You gotta find a way.
Yeah, no, bottom line. And I just one last piece on that is I have a couple of clients that I've talked to that I remember specifically that have, because the agent knew that number, knew the people, got those deals that really didn't exist. And that people, if you didn't have somebody who was in the know and actually doing the work and in the industry and really active with it, they wouldn't have got the properties. That's that. All right, well, let's shift gears. One last piece to talk about today, and this is something that's been popping up a lot in my world recently. It's down payment assistance, and it kind of ties back into that appraisal gap. So down payment assistance are a really hot topic, again, wanting to use other people's money. And there are really great programs out there, but there are also some restrictions to them. And there's also some I guess what I would call some stigma to them from the other side of the table, from the realtor end of things. So I wanted you to kind of talk about if you've had any experience working with them on either side, whether by a listing or buyer's agent. And I can also talk about the programs that are available. But what's your experience having worked with them, or in your opinion, have you dealt with any of those at this point? Did I lose you? I think we might have lost you there, Sarah. All right, so hey, I'll talk about the programs right now. We'll see if we'll get buffered up here. Hold on one second here. Yeah, it looks like we've got.
That's my sound.
Oh, there you go. You're back. We got you. You're back with us. Okay. So wanted to talk about the down payment assistance programs and what they look like from the realtor side of things and also the options. Now, there's a lot of programs out there, but the thing is that they're a little bit restrictive as far as the debt to income, which is money in versus money out, how much you make versus how much your expenditures are. They're not, the interest rates aren't going to be based on the buyer's profile. So there's pros and cons there. They can, if you need the money, they're great. But also if you have a great credit profile and you have access to the money, you can also get a much better interest rate, typically speaking, doing another standard loan. So from the realtor side, what's your experience? Have you had any that you've worked with, whether on the buyer side or listing side, where you've had experience on the down payment assistance? You can't hear me? Okay, so here, let me see. Hold on one second here. Can you hear me now? Lost sound? Uh-oh.
I lost you.
I can hear you. So, interesting. All right, well, we're having technical difficulties here. So hold on one second. Let me see. I'll hear. You know what? So talk a little bit about this here. Bottom line, hopefully you guys can hear me and I haven't lost sound here. Let me see. We're looking good here. I love technical difficulties. It's awesome. All right. Well, so there are down payment system programs and loans out there. There are options. But realistically, it just kind of depends on your profile. And more often than not, you can get down payment and closing cost assistance, or you can also get assistance with the just one or the other as well. All right, guys. So what we're going to do is we're going to come back next week. We're going to get back on and hopefully we'll have better audio. We'll come back next week, cover this topic, and hopefully we won't have the technical difficulty we dealt with. Sarah, thank you. Have a great night. Have a great day. Happy Friday, everybody.